Hi everyone, it's Steve Johnson here and welcome to our Friday Forager video. I'm flying solo today and we'll keep it fairly short. Look, so far this month it's been a resumption of some falling stock prices around the world, particularly the Nasdaq index is now down more than 10% from its peak, and some of the particularly high-flying growth stocks have fallen substantially more than that. It's a welcome development from our perspective. Things were getting very optimistic out there in that space, and I think it'd become a little bit of a casino, and some wonderful businesses in there as well that we'd love to own at the right price, but that's a long way down from where we are now. It's spread to more market-wide volatility as well. We've had more days this month sort of up and down a few percent than we've seen for a few months now. And as a client of Forager, that's something that you should welcome. We thrive on volatility, as painful as it can be at the time. These are the sorts of markets which provide opportunities to make good investments. And you've particularly seen that in our returns over the past 6 months, the volatility of March and April creating some wonderful opportunities. We've talked a lot over the past few months about there still being good opportunities out there, and really the gap between the valuations of the popular stocks and the unpopular stocks has never been wider. We've owned a little Kiwi retailer called Hallenstein Glassons for a number of years now. If you have a daughter in her 20s or teens, you may know the brand Glassons. It's very popular amongst that demographic. This has been a cracking business. It's been growing. Its online offering is outstanding, and yet it was trading at just 6 and 7 times earnings as short as a few weeks ago. The result was out this morning. This company still has quite a significant bricks and mortar retail operation. So stores have been closed in Australia and New Zealand for a significant chunk of the last financial year, yet its profit was only down a few percent. The online piece of its business has been growing very quickly. They've actually given a trading update for this year, the first 8 weeks of this financial year, where sales are up 10% despite stores being closed for a significant amount of time in Auckland and also in Victoria. The online piece of this business is growing like a weed. It pays out something like an 8% fully imputed dividend, and we expect it to continue growing overall into the future. You don't see opportunities like that all of the time, particularly in a world where interest rates are close to zero. But as I said, it's a small example of what we're seeing on a wider basis across the market. The stuff that people are not in love with trades at extraordinarily attractive prices. I actually think that applies to a whole sector in the world at the moment. You can buy some of the world's best banking franchises at extraordinarily cheap prices relative to their book value. Lots of complexities in this industry around interest rates and what margin those companies are going to earn in the future. They are complicated businesses, and at the moment with the opportunity set that we don't have a lot of exposure there. But I just sit there and look at some of these companies and where they trade, where they are dominant franchises in their industry, and I think over the next 10 years there's going to be opportunities in that space as well. So look, welcome the volatility. If you're a client of ours, it's creating opportunities every day, and certainly welcome this bifurcation of the market where in a world where returns are very hard to come by, we're finding plenty of interesting businesses offering up attractive long-term returns. That's it for this week, and thanks for tuning in.